seemed to clearly indicate that he didn't want the market to run away with expectations that this is a peak in rate cycle. He is just pausing temporarily, and that's why that some of the words that he said that you had repeated at the beginning of the program.
But the
But how?
markets didn't react that way.
Yes. So I think what the market is now leading is interpreting it is to say that if you had to increase interest rates, April was the best time in the next 3 or 4 months that you could have increased. You're going to see
Yeah.
inflation coming down into the 5% handle over the next 4 months. And so I think the interpretation from the market at this point of time is that okay, you have not hiked now, you're at 6.5, and going forward, inflation projections are coming down, and you're clearly at 130 basis point real rates. The only reason the market thinks that they will possibly hike is either Fed acts and hikes much more than what is expected at this
Okay.
point of time, or if there is a currency instability angle for the INR, which also doesn't seem likely at this point of time. But if it were to come, so these were the two things. I think the market thinks that the RBI will have to hike going forward. Otherwise, just based on inflation and inflation projection, it's going to be difficult for RBI to justify a hike going forward.
Absolutely. If you don't hike when the last reading is 6.4, why should you hike when the last reading is 5.2? Point taken. Samiran, if you want to comment on the rate trajectory going forward, I'll twist the question to you. Should we now expect a cut? Because at the moment, the positive real rate is 130 basis points. Now, if you go by the MPR, they are saying it is going to become 4.7 to 4.4 year ahead, FY25 numbers. So then the real rate becomes 200 basis points. Logically, therefore, second half should be a cut, isn't it?
So, Latha, the way to think about it and where the confusion is why hawkish pause from RBI has been treated as a dovish pause by the markets is that there is significant difference of opinion about what is the inflation rate RBI is trying to achieve. The market seems to be of the view that any number closer to 5% on inflation is good enough. It's within the comfort zone on RBI, and that's okay. Whereas the flexible inflation targeting framework, the medium-term target is 4%. And today, there was, apart from some strong communication, it was not very explicit that whether future monetary policy actions will try to drive inflation towards that 4% mark. Because if you believe in getting to 4%, then the real interest rate needs to be significantly higher than what a neutral rate is. And from that perspective, there is no need for a rate cut anytime soon when inflation forecasts are all closer to 5% over the next year and even 4.5% by RBI's measure for next year as well. So in my view, it's an asymmetric risk. So a rate hike possibility will arise if inflation surprises on the upside in a big way, and a rate cut possibility will arise only if growth surprises on the downside in a big way.
Okay, so an extended pause is what you would go with. Okay, let me just come back to the real world for a minute. Mr. Khara, if the markets are clearly interpreted the way Samiran is looking at it, long pause. If that is the case, then is business inspired to invest more? Or are even retail borrowers likely to borrow more? Can we see this as a growth stimulus? Because you now know the downside. This is my EMI. It doesn't get worse than that. Does this usually trigger growth, borrowing, loans?
Well, we have seen even in last financial year also, despite the fact that the interest rates are rising, we have seen a very healthy growth in the loan book of the banking system. So I think I would say that the deciding factor for the private corporate and also perhaps for the borrowers, retail borrowers, is something which is not as much influenced by the interest, but more influenced by the opportunities which unfold. And if at all they can reap the benefit of those opportunities, people are willing to go ahead. Though last year, interest rates kept on going up, but mortgage loans, you would have observed that it was a very, very competitive market scenario, even for the retail loans and also mortgage loans. And that's why perhaps the interest rates have not moved up as much for both these segments. And
Okay.
that I think is going to be a guiding factor. Interest rate is one major component, but not the only component which
Fine,
influences
fair
the
enough.
decision.
Fair enough, fair enough. So let me quickly get with from the economists their growth forecast as well. Anything convincing you, Mridul, that growth will be 6.5? That's not the base case when I poll economists.
So I think there's a half percentage point downside to the RBI prediction. But I will add one very clear thing on this. I'm not worried if the growth falls to 6% in this fiscal, given the conditions, conditions they are.
Okay.
I think what we are missing, now an academic, I must sort of, I teach macroeconomics at ICICI, and this is what I tell my students. Actually, your potential has fallen, and
Okay.
it's not really the case to say that we want 7 to 8% wishful thinking growth, and it will be wrong to set the policy on that basis.
Okay. Samiran, your estimate, do you think there is an upside surprise to your own growth forecast, and what is it?
So right now we are working with a 5.9% GDP growth for FY24. I think there could be downside surprises to RBI's forecast of 6.5, but that in turn could make any future rate hikes more and more difficult because inflation then will have to surprise big time on the upside for RBI to justify why they're hiking at a time when growth estimates are lowered. So, in my view, the real challenge is that while RBI in the press conference has been talking about some interest rate sensitive sectors showing signs of slowdown, I don't think that sort of a thing has been fully baked into the growth forecasts as yet.
Okay, fair enough. That's the intellectual discussion on what can happen to rates. We have to take a break. There were several other decisions also announced in terms of the non-deliverable forwards, a derivative instrument which will be available to domestic people as well. And then, of course, the very interesting loans that can be taken on your UPI account. Those discussions as well after the break. Welcome back to a Monetary Policy Special. I have been speaking about Reserve Bank's surprise pause to some of the veterans from the market. Dinesh, Khara, SBI Chairman, B. Prasanna, the Head of Treasury and Global Markets at ICICI, Chief Economist of Citi India, Samiran Chakraborty, and Mridul Saggar, former ED and member of the RBI's MPC and now a Professor of Economics at IIM Kozhikode. Gentlemen, thank you for your patience. Prasanna, I wanted to ask you what kind of range you are looking at. Okay, what kind of range you are looking at for the bond market, and what are you looking? Do you expect any liquidity easing measures later on in the year, because there is a massive borrowing after all, and liquidity is already just about evenly balanced?
So Latha, today I think there's been a kind of a knee-jerk reaction with the short-end bonds falling by around 12 to 15 basis points, and the 10-year yields also falling by 5 to 7 basis points. But I think the way it's going to happen is that since the rate view is getting more benign than what it was earlier, the short end will continue to perform better. We may probably see the 5-year even going up to going down to 7% or maybe even below. But since the borrowing program is heavy, I don't think the long end deals are going to react as much. So we will see a bullish steepening kind of a thing playing out as far as the US or the Indian yield curve is concerned. What is the other question, Latha?
Rupee, I mean, how do you see the currency as well react?
So I think you have also discussed it quite at length in your various shows. Clearly, the view on the current account deficit, as far as India is concerned, has got substantially better, and we are now most of us are kind of expecting less than 2% of GDP. The CAD would be around maybe $50 to $60 billion next year, and I think it can be pretty easily financed. On top of it, you have also a dollar-X view, which is kind of getting a little negative, or I would say weak dollar view, because of the possibility of higher hikes happening in Japan, Euro, as well as the fact that with the dollar peak in sight, there are a lot of flows which are possibly coming out of the US into emerging markets and commodity currencies, including India. So I think what all this means is that there is a benign view on the rupee going forward. So the RER, by the way, is a very comfortable 99, down from around 105 6 months ago. So from all that perspective, I think the view on the rupee is quite positive. Now, the only, I should say, doubt is whether RBI will actually let the market forces operate to let the INR appreciate. I mean, left on its own, it can possibly even touch 80, 80 half. But I'm not sure whether the RBI would really want it to go all the way to that level. They will probably want to, keep intervening and recouping the reserves that they probably lost. They have recouped a lot of it, but I guess some of it they would probably going to recoup it as well as we go forward.
Oh, absolutely, and perhaps even keep the edge for our now burgeoning services exports. Mr. Khara, I wanted to ask you, what does this do to bank margins? I mean, you all are a big 40% of the Nifty. I mean, finance companies, banks. Margins now crunched. Competition from the bond market is there. You can't raise rates anyway for the EBLR, the linked, repo-linked loans. And immediate liquidity is tight. You have to pay more for deposits.
Well, Latha, I think much of it will be the play which we'll get to see in the how it unfolds in the days to come. But yes, of course, I don't think so that margins will get into compression immediately, because we have always seen that when it comes to deposit liabilities, recalibration of the interest rate in case of liability, it is with a lag and with a substantial lag. And so I think we don't expect that to really happen. And as far as the loan book is concerned, part of it is also the function of the kind of demand which will be seen for various loans. So I think that's how our ability to charge the prices or the interest rate will depend upon how do we really play out in the market for the loan demand.
Okay. All right. Perhaps not immediately, but it does look like if the Reserve Bank is in for a long pause and liquidity is tight, then maybe the best of margins is behind us. Samiran, what do you think about liquidity? There is this massive borrowing program, and we are not going to get perhaps the same help from mutual funds and insurance companies, given the tax changes. Do you think we should perhaps bake in even a CRR cut second half?
So, Latha, the issue is that from a durable liquidity perspective, we are already back to where we were pre-COVID, even below that. So the entire withdrawal of accommodation from a liquidity perspective is already done. But the fact that RBI has not changed that withdrawal of accommodation phase means that any liquidity infusion in the near term would be difficult, particularly durable liquidity. RBI can keep on doing the fine-tuning operations in the form of variable repo auctions, but either CRR or OMO, while the stance is withdrawal of accommodation, will be in contrast with the stance. And that's why my sense is that why we were looking for a change in stance was one of the reasons was that a change in stance would have given RBI the operational flexibility to address any demand supply imbalance issue in the bond market through OMO in the near term. But if for some reason RBI believes that that is not a major problem in the near term, then maybe these two things can happen together, where there will be a change in stance and followed by the CRR cut or an OMO.
Okay. Well, maybe the Reserve Bank wants to achieve through monetary tightening, actually liquidity tightening, but not wanting to hike rates, and that it delivers on its inflation targeting goal as well. A little confusing, but that could be the thinking behind this. Mridul, out of time, but I must ask you this question. Do you think they let the rupee appreciate? Or will there be a worry that exporters will now not want to convert into rupees because there isn't so much by way of an interest rate gain, and there is, the dollar interest rates are not too bad. So how will the Reserve Bank think about the rupee? Will they let it appreciate?
I think there's some little I mean, if we are talking of global spillovers and global outflows, then you can't have rupee appreciate. I don't think that would be the objective of RBI to fight inflation by appreciating the rupee. So that's ruled out.
Okay, ruled out. That's very important as a takeaway for businessmen as well as for traders, that rupee appreciation deliberately allowed by RBI will be ruled out. Well, that answers a lot of questions. Thank you very much, gentlemen. I'm unfortunately out of time, but that helps us understand the monetary situation much better. There is going to be pressure on margins, there will be pressure on liquidity, but for the moment it looks like the Reserve Bank will keep its inflation fighting mandate on, maybe not with hikes, but by keeping a control over liquidity and maintaining the stance as withdrawal of accommodation. Thank you very much, Prasanna, Samiran, Mridul and Mr. Khara.